All right, happy to take a look at ECN Capital. So this was an email from one of our viewers. ECN Capital is actually a company that was part of Element Fleet Financial. They separated years ago, back in 2016. So this is a company that we are quite familiar with. Element as well, and we've done a Your Stock Our Take on Element. But let's take a look at ECN here. So symbol is ECN, just like the name. Stock price right now of $1.70. It's just under a 500 million market cap company, and it pays a yield of 2.3%. So what do? They originate, manage, and advise on credit assets like consumer loans and commercial loans on behalf of customers. And those customers include financial institutions like banks, credit unions, life insurance, pension funds, institutional investors across North America. Now, this company has had very poor performance over the last year. Stock price is down by almost half in 12 months, and it's also been a very volatile ride for the investors. But it's not just the last year; it's been really the last couple of years that this company has really struggled. So, looking at the stock price here, if we go back to late 2021, the price at that point was close to $12. So it's come down quite a bit. Now, one thing to mention is that in December of 2021, the company made a major asset sale of its service finance business. So in connection with that sale, they declared a distribution to shareholders of about $7.50, and that's why we see such a big drop at that point in time. Now, that's typically what we would see in a situation like this when a company declares a special dividend, particularly if they sell a big portion of the business or if they had a lot of cash and then they distribute that to shareholders, because that's no longer part of the company anymore. That needs to be reflected in the share price. So this big drop from $12 to about 550 or so, it would be expected. And this isn't necessarily anything bad that the company did. I mean, they distributed money to their shareholders. But even since then, we've seen pretty much nothing but a downward trend on the stock price since 2022. So one of the things that's important to understand with ECN is that they're very focused on two specific areas of the credit market. So these are manufactured housing and then also RV and marine. So these are the two areas. These are their niche areas. The business was more diverse in the past, but they've been going through a multi-year transformation of selling assets, as I discussed a couple seconds ago, and then just focusing on what they consider to be their core business. So we consider this to be a very niche, very focused uh, finance company, given that these areas are they're not, it's not widespread. It's not like they're doing loans for single family housing or apartments. It's very focused, and that can be a good thing or a bad thing depending on the niche markets that you focus on, of course. But why has ECN share price performed so poorly over the last couple of years? Well, one of the big things, which won't be a surprise to people, would be the interest rate environment. So the core business of originating and servicing consumer loans, particularly in their markets, have faced headwinds, and this is due to interest rates, also inflationary pressures, and concerns over economic slowdown. So I'd mentioned before that having a very precise niche focus is all right. It's a good thing as long as your niche markets are strong. But if they're not, then obviously the company is going to suffer because you don't have much diversification. So there has been a slowdown in their space. This has led to generally weak financial performance, so lower revenue and net loss in 2023, and then also for the first quarter of 2024, companies struggling with profitability. So it's obviously not going to get a great valuation or great treatment in the market. Now, there is this multi-year transformation strategy that they have that has resulted in major asset sales. But what this has also done is it's caused a lot of noise and complexity in the financial performance because the historical financials aren't really comparable with the current financials, given that these sales have existed. So this just makes it more complex for the market to analyze the company, and that's typically not a good thing. So although they do have a transformation strategy in place, I'd say that it's really not clear exactly how they expect to drive long-term growth, or how this transformation strategy is really going to be a benefit to shareholders. And of course, the dividend has been reduced. This was after the sale of their service finance business in 2021, but the dividend was reduced from 3 cents to a cent per quarter. And looking at that right now, the yield is relatively low and there's been no dividend growth. So as a dividend paying company, it doesn't really have a lot to offer income investors. And just looking at the financials for 2023, it was a challenging year for the company. So revenues were down 21%, adjusted EBITDA down 22%, and then adjusted earnings per share were negative 4 cents for the year compared to positive earnings in 2022. Similar story for the first quarter of 2024, a little bit better, but revenue was actually up almost 4%. But adjusted EBITDA was also down. And again, they reported a net loss in the quarter compared to positive earnings in the first quarter of 2023. So looking at the balance sheet right now, they have, as of the first quarter of this year, they have about 631 million in debt. I would say that the balance sheet leverage looks moderately high, certainly at this level, relative to assets. And I would say quite high relative to earnings, given that there are no earnings. But one thing that I will say in favor of the company here is that they have been reducing debt. So the debt has gone down from over $1 billion in total debt in Q1 of 2023, so a year ago. So there is some deleveraging of the balance sheet. But still, it's not a situation where I would consider the balance sheet to be particularly compelling. Now, also just looking at analyst estimates and valuation going into next year, I'm just going to use some of the analyst estimates off of Yahoo. Definitely take these with a grain of salt. But according to Yahoo, there's 7 analysts that are following the company, and they're expecting earnings per share of 17 cents in 2024 compared to a loss last year, and then growth again in 2025 to 26 cents. So this certainly indicates that there is potential for an improvement in financial performance over the next couple of years here. But when I look at these numbers, so 17 cents in 2024, that would put the valuation at about 10 times earnings. That's still not very attractive for a financial company, certainly not a company that has had the difficulties that ECN has had. And then if I look at the 2025 estimate, so 26 cents per share, that's going to put it at around, 7 times roughly. So it's a little over 7 times actually. So it's that's a better valuation, but that's only now really putting it in line with a lot of other small cap finance companies. So in the finance space, we're typically looking at lower valuations already. So even if everything goes well with the analyst estimates in terms of them achieving these numbers, they're still not trading at valuations that I think are so compelling that we would want to rush into the stock. So our take on the company, well, on the positive side, improvements in the balance sheet, potential improvement in the operating environment as rates decline. And I think this is the main thing. If we enter into a period here where rates start to decline, certainly we would expect that to be a benefit to ECN. So there is some speculative upside in a declining rate environment. But looking at the company right now, what I'm seeing is weak financial performance, lack of profitability, which is a major factor for us. It's not just that they've encountered a lot of challenges; they're not making money in terms of net profitability. And really no clear strategy to produce consistent growth. So we really think that it's too speculative. I think that it's too focused in these two niche markets. I don't see the benefit of that to shareholders. But really, we would consider it speculative at this point. We think that there are better opportunities in the financial sector for anybody who wants to invest in that space.
I think that's the key at the end. We do have other companies right now in coverage that are delivering, trade at reasonable valuations, either growing their dividend, growing cash flows, and again, trade at those reasonable valuations. And it's just ECN doesn't make the cut for us in terms of our coverage in the financial sector in the Canadian markets.
Well, we have one in coverage just off the top of my head in our income space that has similar yield, but they're growing their dividend, at 20 to 30%. They're growing their earnings per share. All the financials look good, and it's still trading at about 9 times earnings. So, similar, even lower valuation if ECN hits their analyst targets for this year, and just better financials across the board.
Yeah. So we would, again, as we look at all companies, we would prefer those. And that's why we make recommendations on those. And when we look at ECN, we do dig into it, but it doesn't meet our criteria.